My name is Paul Spirgel. I am with Forex. Today's webinar will be on FX Urban Legends, stop hunting. Before we get started, let's take care of a little bit of the legal work. And for that, foreign exchange trading carries a high level of risk that may not be suitable for all investors. Leverage creates additional risk and loss exposure. Before you decide to trade foreign exchange, carefully consider your investment objectives, experience level, and risk tolerance. You could lose some or all of your initial investment. Do not invest money that you cannot afford to lose. Educate yourself on the risks associated with foreign exchange trading and seek advice from an independent financial or tax advisor if you have any questions. Any news, opinions, research data, or other information contained within this presentation are provided as general market commentary and do not constitute investment advice. Portfolio expressly disclaims any liability for any lost principal or profits without limitation, which may arise directly or indirectly from the use of or reliance on such information. Okay, that being said, let's get into what it is we're looking to talk about. Throughout the years, and the retail FX market's been going now for about 12 years or so, 15 or so if you count some of the early iterations. One of the most talked about myths in foreign exchange trading, institutional as well as retail, but it's gained a lot more momentum in the retail world, is stop hunting. You know, what is stop hunting? First off, what is the history of stop hunting? How pervasive is it? And should the retail customer be concerned? And then down the road, what are your options if you suspect that you are a victim of stop hunting, and how can you protect yourself against potential stop hunting? Now, there are many different definitions of what stop hunting is, but the most all-encompassing definition I could find was a stop hunter is a market player that attempts to trigger the stop orders of other traders for their own benefit. They generally have the capability to move the market by a small degree for a short period. The stop hunter may be a forex broker's dealing desk, which is trading in competition with its customers, or it may simply be a large player in the market, such as a bank, a hedge fund, or some other institution that has the ability to move the market for a short period of time. Okay, that's a decent definition, and again, that's a non-nefarious, relatively legal definition. And to go back to our syllabus, what's the history of stop hunting? The history of stop hunting is really in the market, in the interbank market prior to the retail foreign exchange world. You had what were called order banks, and at the end of a day's trading in New York or London, orders get passed by different branches to different trading zones. For instance, at the end of European trading, a European bank will transfer its order book over to its New York bank, and then after New York trading, New York will transfer its book over to Asia. For the most part, the intervals between Asia and Europe and New York are still pretty high volume zones. There's a good amount of drop-off in the volume of trading that goes on between New York and Asia. For those of you that trade in that market, you'll know starting at around 3:30 or so, after we've gone through the futures close between 3:30 and the Japanese open for the most part at 7:30, 8 o'clock Eastern Standard Time, it's generally a very dull and dead time. What happens in that period of time is the different time zone that's in there. For that time zone, the only really active is a bit of a misnomer because they don't really do much other than actually just watch their orders waiting for Japan to open up, is the Australasian time zone, which just means really Australia and New Zealand. They get in earlier than the rest of Asia. Again, New Zealand is the first stop in the opening of the day, and they're in a good 5 hours or so before Japan opens up. So what happens every now and again in the legit world is that some of these banks will see they have good orders coming from all over the globe, and if they notice there's opportunities along the way to move the market, 15, 20 pips to capture some stop losses, they tend to move the market. That's why in the interbank market, between banks, brokers, and some hedge funds, most of the market participants will widen out their stop loss orders, and some of them will even take them out and watch them manually themselves because they're not interested in getting, this is a market term, jerked around by the market. It's a very low volume period, and it's a known issue that they'll go looking for stops. And looking for stops is not it's not a nefarious thing. If you notice the market itself, throughout the liquefied day, being the hot zone of New York, London, or even Asia, the market's always testing new levels to see where the path of least resistance is. You know, there'll be probing trades going on to see if there's offers ahead of somebody who's trying to buy, or if there's bids ahead of somebody who's trying to sell. And that's how the market really sets its ranges. They trade around a certain range, constantly hitting bids and taking offers to see where the orders are. You know, the most important friend to most interbank and hedge fund traders are where are the big orders. That's what you want to know, because you can move markets around in between those areas, but when you run into a big order, that's where you want to stop. So on some of the different dealing services that the institutional players use, they'll keep buying and selling all along the day, trying to capture spread. But if somebody keeps hitting a bid and they see the same name coming up as a counterparty over and over within a certain area, they'll say, all right, that guy's got a good bid. Or if they're trying to pay an offer and that guy has a good offer, then they'll stop, and then the market will go back to trading its range. The objective, as a trying trader is asking, is like everybody else, trying to make money. It's not, again, in the early days of foreign exchange, before there was a lot of competition and before the technology reached the level that it is now, there were some firms out there that would try to take advantage of customers. There was a lack of information. Price discovery in foreign exchange is still very ephemeral. There's no real time and sales in the interbank foreign exchange market. Individual banks have captured data on bids and offers. They get prices from EBS and Reuters, but it's not exchange type data where you know exactly what's been going on. And in the early days of retail foreign exchange, there were some firms that would just arbitrarily move the market 5 or 10 pips outside of what the real market was, just to capture some stop losses. That is certainly unethical, probably illegal, and it doesn't go on much, because if you keep doing that kind of business, your reputation as a crook gets out in the market and you perish. The best way to combat something like that is go with the most well capitalized, the number one firms that are licensed and have ongoing audits and have a clean bill of health with the NSA or the FSA or any other regulated bodies. Again, you know, the same logic holds true on everything. You know, if a deal sounds too good to be true, people guarantee stops, bills, and some of these other promotions that are out there, you know, you should always treat some outlandish claims with a healthy bit of skepticism. Getting a couple of questions here. The ratio of dollars relative to current volume to move the market by a pip. There is no real number. Again, banks are set up in many different ways they have different desks that handle different types of order flows. You have smaller desks that deal with, say, 0 to 10, $15 million worth of risk. You have trades that deal in the 15 to $50 million, and you have some very large desks that only deal in $250 or $500 million deals at a clip. Suffice it to say, during when New York and London overlap between 7 a.m. and say 11, 12 a.m. in New York, you know, 2, 3, 4, 5, 600 million, you could get maybe a 1 or 2 pip move. There's a lot of players on both continents that are making prices. There's a lot of hedge funds that are in the market. There are a lot of now what they call algorithmic traders, which are akin to EA traders, people in the meta universe out there. And there's lots of volume and liquidity, and, you know, barring any news that people are running away from, rate decisions, some, you know, explosions in the world that would, you know, be one way, as long as there's good bids and offers on either side, it's it's a very deep market, and it takes a lot to move it a couple of pips. There is no set formula. In some of the slower time zones, early Asia being 7 to 9 o'clock in Tokyo, and nobody in New York when Tokyo first opens up, it'll take a little less to move the market. And during Australasia, which is the prime area or the prime time when stop hunting takes place, it doesn't take that much at all. And again, it's wise to be careful in that time zone. Boyke's asking if wider stops are better. Wider stops aren't better. Your risk management is your risk management. But what you should be aware of is where the market is in terms of some technical levels. And as a rule, I'm not generally a technically based person, but if you look at the screen, and I'll reset my camera just to make sure you can get a look at it. All right, you can see I have a picture of a Euro chart on the board, and okay. So what we've got here is a Euro chart, a 4-hour chart. It's nothing. There's no real reason, technical level otherwise. But the point that I'm trying to highlight on this chart is, if you notice, and not even have to notice on the chart, but if you recall, 133.20 or so has been the top of the Euro range for the last while. So if at the end of the day today we were to head up into the 133 area, and most people would have a stop here probably at 133.30 or so. So if we were within 15, 20 points of that level, there's a good chance that the Australasian dealers would take a run at that 133.20-30 area, which is a known stop area, a known area of resistance, just to press to see if they could actually run it higher and get some stop buying to take it higher for them, and then they could make some money. In the middle of a range, where we are now at around 131.60 or so, they may try to lean a little further down on the 131.15-20 area, which was, again, it was another area of support or old resistance, just to try to shake things through, just to see where it goes. So setting wider stops is not necessarily the answer, but setting intelligent stops. What the stop hunter does, and again, I don't say stop hunter in a, trying to castigate the people that do it. It's a legitimate thing that goes on in the market. There's nothing evil about it if it's done legitimately. Guys who just mark things up just to take out stops, that's no good. But what the stop hunter does is he checks out a chart, he looks at an order book, he sees where the areas of weakness are, and he goes after it. There's nothing, for the most part, as we know, everybody looks at the same chart. A lot of people, even people that give technical webinars on FX Street or other services, they all look at the same things, and a lot of the information, the 200-day moving average, the 50-day moving average, all the other technical indicators are known. 20 years ago, you didn't have as much information out there in terms of technicals. You had a bunch of guys sitting on desk that would create their own point and figure charts, and that was as much technical as you got. With the recent computer power, there are new technical indicators, and just the spread of information is pervasive. So those people have access to all this information, and like I just said, obviously 133.20-30 area was a good resistance area. If we go through there, there's a good chance that there'll be stop buying. A lot of the banks that I talk to say if we go through 133.25, we could be on the way up to 134.30. CNBC, Fox, CNN, assorted other news services, they all put this information out there. So what you want to do, and not necessarily widen your stop or go for longer time frame or the stuff, be cognizant of what those levels are, and just pay attention to the fact that there is a good chance that some traders out there will try and take advantage of that level. They take advantage of levels throughout the day. These dead times are no different. In fact, for you meta traders out there, if you recall a couple of years ago, the popularity of the FAP Turbo EA, that was pretty much doing the same thing. It was looking for a period of low liquidity in the market, which was between 3 and 7 in New York when there wasn't too much action, and they were looking to do mean reversion trades, which just means, selling the tops of ranges and buying back towards the middle of the range. It was taking advantage of the same lack of liquidity, but in this meta universe, what it was instead of one bank doing the damage, it was this one EA that was held through, thousands of little traders dealing anywhere from 1,000 to a couple of million at a clip, and they were beating up on the market. A little bit of justice, because sitting in some of the firms that I was sitting at, a lot of the large banks were actually very concerned about what was going on, especially some of those Australasian banks that were making markets in that 5 to 7 range. So it's a little comeuppance to the guys that have been doing it all along. But again, it was nothing particularly nefarious about it. It's just, when they say watch where you leave your stops, that's another thing to watch for when you're leaving your stops. You don't necessarily want to be in where the rest of the crowd is. You want to try and differentiate yourself. And one of the the basic rules of trading is you want to keep your powder dry and maximize your ability to stay in a trade. That being said, trade location is optimum. That's why a lot of people look at covering some trading or closing out trading before New York close and reestablishing once again when Europe opens up. That's one way to get around it. But for some people that are in a trade, it's you might want to watch it yourself and be very careful, because you will get some good run-ups. And having been a dealer on an Asia desk for many years at several different interbank firms and retail forex firms, I could tell you that there's an interesting correlation between the price where the market closes at 4:30 or 5 p.m. in New York time and where Tokyo opens up. Every now and again, the market will take some little walkabouts, as the Aussies call it, and then by 7, 8 o'clock, when Tokyo is getting set to open up, it seems to mysteriously return to the approximate range where it was at 5 o'clock. Which again just tells you that some forces were taking it up in low liquidity, but as we get back to more normal trading, it settles in where that price was. Why do most widen stops during certain data releases? Boyke wants to know. Well, that's simply because that's what the market pricing does. For instance, around NFP, which is one of the most popular numbers, the banks widen rates around economic events. Euro will be trading, say, 2-3 points wide, pips wide, under normal circumstances. When news comes out, there's uncertainty. You don't know where it's going to go, and the prices just widen out 10, 15, 20, sometimes 30, sometimes even 40 pips wide. That's it. Remember, in this electronic world, that on some level these prices are still made by people. And the same way that you have a fear of what you don't know or where the price is going to go, these guys sitting in the big banks, they have no idea. The price will be, 131, 50, 52 all day. Then you get an economic number comes out, and you don't know which way it's going to go. He says, okay, now I'll buy at 30 and I'll sell at 70. What do you want to do? It's a price. And again, remember that, again, as electronic as everything is, there are still people that are behind these prices, and there's a fear there. Nobody wants to get hit too hard on one side, so they widen spreads. Widening spreads is a defense mechanism that dealers use to either say they don't know where it is and they don't want to get hurt by making a price, or that they just don't want to trade at all and, go find somebody else who has a smaller trade. They'll deal at this rate, and everybody knows it's not particularly competitive. If you want to deal, then deal. If not, go look someplace else. Let me just check here, see if we have any other questions that I may have missed. In my experience, would you say this thing happens or is relevant to the top 50 brokers? Well, as for the top 50 brokers, there isn't much stop hunting that goes on. Every now and again, the problem with stop hunting is, especially in the larger brokers that have good two-way business, you can't really move a market to the left or to the right in any meaningful way. Don't forget, if the market's 50-52 and you start showing a 55 bid, first all the EAs will go off and they'll start hitting your bid, which will then put you in, you'll be long dollars above the market, which you don't want to do, especially if you're a firm that does, that takes on the risk. If you're a STP shop, then nothing will get done because it won't go through to your broker. But it's just not good business for these firms. The reason these firms are in business is because they expect to make profits, every day. For a one-off chance to capture, a couple of pips on the left or the right, they can't target individual traders. Again, because even if they go after one of their larger accounts, with the EAs and the other, electronic trading that goes out there, it wouldn't be cost effective. They have no, they make 5 pips on a guy with a $2 million position. They're going to lose 5 pips on all the little guys that are going to flood in through EAs. So it's not a business they look for. First of all, it would be labor intensive, hiring people to keep fishing around for all these trades to go look for who to stop hunt on and who not to. Some of the smaller guys that don't have a big book and they could actually look at individual traders, they can try and stop hunt. But again, price disclosure in foreign exchange markets is so deep these days that you can't fool anybody. If you're going to take somebody out of the market at 60 when the market is 52, 54, they're going to know about it. They'll call up 10 different shops and say, what price did you have it trading at this exact second? And they'll tell you, and you go back and you'll say, that's not a decent price. What are you trying to do to me? So that's the pervasivity of stop hunting is, it's out there. It's a legitimate tool that some people use when you can use it, depending on market conditions, being if we're at the top or at the bottom of a range and you could, and you're in, and you're within range of some of the stop areas, some of these dealers will go for it. And bear in mind again that it'll happen during liquid times as well. That's what running stops are, even during regular times. But a lot of it happens in low liquidity times as well. And you should be concerned about it, and you should manage your stops accordingly. It's when I was sitting at some of the larger banks, you would have people that you would give orders to. I worked at one of the big British banks, and he would give his stops out to a big Swiss bank because he had a friend there that was sitting on a desk there, and he would watch his stops appropriately and keep them in when there was some noise that was going on. So stop losses are a very personal matter, and they require serious attention. But take profit, everybody's happy when a take profit goes off. When the stop loss goes off, you want to make sure you got the right fill at the right time. And unfortunately, there are going to be a lot of times where you're filled at the high or the low. Again, if you're looking at some of the more popular charting services or technical services, if everybody's looking at the same levels, then, there's going to be a lot of people getting stopped out of the level on purpose. Where do we have it? Firms that trade off weekly charts when they set up those long-term trades. What do traders do all day? Well, I don't know specifically what you mean by the firms that trade off weekly charts. You have inside of dealing rooms and on the dealing desk of the most major banks, say the Euro dealer, he may have some long-term positions on. He gets that off his book. What his real job is all day is to sit there and provide liquidity for the bank's customers. So say the guy sitting in the Euro seat at JP Morgan, he's out there making prices to Microsoft, Disney, GM, a bunch of hedge funds, everybody. He's just providing them intermittent liquidity all day. If he has a view, he may put on a longer term trade, and he'll just put that in a separate account that he doesn't look at all day, and he'll just adjust that accordingly. But for the most part, he's still trading all day against other counterparties, taking care of the bank's business. Have dealers in the past moved their price away from the market? Well, again, that same dealer who's sitting in the Euro seat, if GM comes in and says they need to buy, 250, 300 million euros, and it's sitting at the end of the day, 3, 4 o'clock, and liquidity is going to dry up. If the market's 50, 55, a dealer may come in and say, I'm 58 bid for as many as I can get. So they could move, and if the demand is that high, and that's why prices move, because there's a lot of demand for something, and it goes higher. That's not necessarily falling under the aegis of stop hunting. That's just supply and demand. Somebody needs it, they'll pay over a price, and they'll pay to keep getting it. Now, there are issues where, believe it or not, EBS, one of the large electronic broking services between interbank dealers, somebody put in a wrong price in Euro Swiss and threw the market in an uproar. So that happens as well. It's called, fat fingering. People, again, there's a human element, and there are problems that happen like that. There have been problems in the market where people have just put in a wrong grade. I remember there was one story that a couple of dealers were throwing a football around on the desk. Some guy missed the catch, and it wound up hitting his broker station, and he just wound up selling dollar yen, right through a market level, and cost people tons of money. You had in equities last year, you had the flash crash where people put in the wrong prices. So these mistakes do happen, and the market does what it can to rectify them when they can, but it's a part of the business. How many pips above resistance and below support do they hunt? There's no set amount. They go after the area, and like I said, markets look for the path of least resistance. If they start selling and it keeps going lower, then the markets will keep selling. That's why on some levels, some of these EAs that are now prevalent, they keep buying into falling markets, and as the market makers keep selling it, they'll keep selling it, because if it's going lower, it's going lower. Doesn't the market gravitate to where the most orders are? Not necessarily. I mean, you have, there's certain elements of people that just leave stop orders, on the outsides of the market just as an insurance policy. So just because you have those orders there. But what the market deals on is just flow, different supply and demand, bids and offers throughout the day. The orders, are really left, people will leave take profits to a certain degree on the interbank side, just because, in case they miss it and the market flies higher, they want to be in it and be able to sell some. But, the markets don't gravitate. Yes, they're an area of interest that tips a little bit of the weakness along the way. If you see lots of stops above the market within 20, 30 pips, then you know that the market's short and they're looking to buy on a stop above. So you either say, if you have an order as a dealer to sell, you may want to jump in on that, or you may say, well, let me take a shot. I could sell to these guys higher as they're going to be buying euros off me. Maybe I'll take a run at it that way. But again, during highly liquid periods, there's no real incentive to go after the stops, because you could run into other dealers that are doing the opposite of you, and you can get hurt. During these low liquid periods, like we were saying in that Australasia time, or even some of the time in between some of the sessions, they're more likely to take a shot. Let's see what questions we may have here. Stop hunting is a way for these banks to force price to achieve the price. The traders whose stops have been triggered are the ones who are taking the other side of the trade. Yes, I suppose, but it's not like there's a movement afoot to just go after them throughout the day. Again, and not to belittle the markets, but a lot of these traders are concerned with their market making throughout the day, dealing with the myriad of corporations, hedge funds, and all these other entities that are looking for prices all day. They're not, they'll know where orders are because they have to cover those orders. So some of the order filling is just preservation. A customer has said that he wants to buy 100 million 10 points above the market. if you don't fill him, you're going to owe him a fill within 3 to 5 points of that fill area. If you don't get them in and the market moves higher, you're going to have to owe a fill at a much worse price. You can do two things. You can give the bad fill and you'll never see business from that guy again, or you can give him the good fill and you'll see some more business. So, it's not like it's just a free-for-all for the banks to go out and print money. Dealers have a lot of pressure out there to give the right fills and to maintain orderly markets. Can a small dealer change the price on their feed supply or customers away from the actual market price? 100% they can. The small dealers, the different retail brokers, they all have control over their pricing mechanism. They can go inside and go off floating or being the API feed from the big banks, and they could either adjust to the left or to the right, or they could go ahead and just change completely. Again, there's no real interest for the major retail players to do that. It's not particularly profitable. It's actually labor intensive and prone to errors, and it's just not good business. You don't if you're one of the major firms, you don't want to get a label out there of being that type of dealer. It's just not. There's no benefit to it. As a trader, how significant is a wick? Time of day makes it more impressive. Well, the wicks really just show the different flickers. It's it doesn't have much to do with stop hunting per se, but a long wick will show like just a flash move that doesn't have much behind it. What it does show is that there is some interest to do something there, but it just wasn't followed through. It looks more like a one-off type thing. So it has significance in how you should look at the price action, but it doesn't really have much to do with with stop hunting per se. Do only the big boys hunt? It takes a lot of capital. No, I mean, like I said, the EAs, in those periods of low liquidity a couple of years ago, were having a dramatic effect. In EURUSD, dollar CAD, sterling Swiss, they were moving it around pretty well, and they had the big banks all concerned about what was going on. It's a concentrated big move. It didn't necessarily have to be one particular player or one particular bank, but when in mass a large amount of euro sterling, euro Swiss, or sterling Swiss goes through at a given point, it can move markets for a short period of time. Again, the dealer doesn't have the bank dealer doesn't have that many opportunities to go out and cover in dead time, so he'll just go and pay any price. Then the next guy that he sold it to will go out and pay any price. Then once more reality comes in, it'll stabilize. But for those first few flickers, you could have a very dramatic move. Next question, will an American and European bank operate during Australasian in order to go for stops in the market? Well, American and European banks do operate in those time periods. In Australia, in New Zealand, in Hong Kong, Singapore, most of the major banks have 24-hour presence, and they're in those markets. And the retail firms that you deal with, you get pricing from those players, so they're in it. I mean, do they go after stops? Yeah, I mean, by Australasian, I mean a bank in that time zone. It doesn't just mean the Australian banks or the New Zealand banks. It's the dealers within those banks at that time. They go for it. Do central banks stop hunt when they interfere? No. I'm getting the 2-minute warning here. Bank traders, do they use charts assisting trading? Yes. Bank traders have definitely looked at different, personal levels that are important to them. Are we better off having an account with a bank or a retail broker? That's up to you. At this point, the rates are really just a customer service issue down the road. The rates are the same pretty much everywhere, and that's your personal preference. Before we go, I just want to go, what can you do to protect yourself against stop hunting? There are, and there will be, flickers in rates, bad ticks. If you have any questions about a fill that you got, go in and call a customer service area and be firm, research the rates, know what your rights are. Don't let them stonewall you and give you a story about what happened. If you're firm about what you know was a bad fill, speak to a manager, and if you have to, bring it up to the NFA or whatever regulating body out there. Firms do not want any black marks on their name. So they're almost always ready to chalk it off as, a mutual error and give something back. But by all means, stand up to your rights and do not, if you feel you've been wronged, get your due. What are the hours of stop hunting? The hours of stop hunting, the prime hours when they do happen is that dead area in Australasia between, say, 4 New York time and 7 New York time. But stop hunting happens whenever we're in range of stop. People will go for it, again, just to see what they can shake loose. It's a natural part of trading, why markets move. There are more buyers and sellers at any given level. And stop hunting just means there's a concentration of buyers or sellers at a certain level, and they go for it. That's it. And as we're winding down here, let me just give you a little story on FX Folio. We are a team of industry professionals with varied experience. We have traders like myself. We have customer service people. We have different products and services. We have trading signals. We have a live trading room. We have EAs that we can hook you up with that run on different criteria. We deal with most of the large retail brokers. Alpari is our preferred. We deal with FXCD, FXCM, Forex.com. And I encourage you to check us out on our website, www.forexfolio.com. And there's information on there to how to contact us. And again, know your rights when you're dealing with stop hunting. It doesn't happen often, but by stop hunting, again, there are bad ticks all over the place, and those come from banks, and there are adjustments that need to be made on accounts. If you see something fishy in your account, call up, because unless a lot of people complain, some of these brokers, even the most reputable ones, don't do anything about it. Even the CFTC and the NFA. I've had a customer of mine who had a bad fill in futures in Chicago, which is heavily regulated. And when we asked him about the bad fill, he said not enough people complained. It was off market, but since not enough people complained, they were letting the trade stand as it is. So it's your money out there. Be vocal and protect it. And on that note, I will thank everybody for attending. And again, if you have any questions or comments, you can reach me at paul.spirgel@forexfolio.com. And good trading, and thanks to the FX Street people for the opportunity.